Hey guys, David Robinson here. Welcome to the apartment investing journey. We've got another great guest for you today. I'm really excited to have Jeremy Roll on the show with me today. Jeremy, thank you for coming on, spending some time with us, and looking forward to our conversation.
Absolutely. Thanks for having me here. Hope this is helpful for your listeners.
So, Jeremy has been invested in passive cash flowing real estate opportunities since 2002, and he left the corporate world in 2007 to become a full time passive cash flow investor. Jeremy has now invested in more than 150 to 200 plus opportunities across many asset classes, including real estate and non real estate opportunities. He is also the founder and president of Roll Investment Group, an investor group with over 1,500 investors who seek passive managed cash flow opportunities. And so, Jeremy, I sought you out to have on the podcast for a handful of different reasons. I think you're a super sharp guy with a tremendous amount of experience as it relates to investing, and you have some unique perspectives on what's happening in the market. And so I wanted to have you come on and chat about that. But our podcast is all about the journey, and so I would love it if you'd be willing to back up and talk to us a little bit about your backstory, um, background, and how you got into real estate investing, and then your transition to full-time passive real estate investing.
Sure. Yeah, sure. And thanks again for having me on. So I'll go way back. So I'm from Montreal, Canada. I spent about half my life there up to this point now, and I've been in Los Angeles for the other half. But what happened with me is I was, from an investing perspective, I was in the US starting in 1998, did an MBA at the Wharton School or UPenn. I graduated in 2000 and started to work up the corporate ladder. I'd already have a few years of corporate experience prior to my MBA. And my intention was just to kind of go up the corporate ladder. I was kind of hitting middle level management at that point. And in 2002, just after the dot-com crash, I was just sick and tired of the lack of predictability and the volatility of the stock market. Just the thing that bothered me the most is just from a retirement account perspective, not knowing where my retirement account would be in 10, 20, 30, 40 years because of the volatility. Like, I'm a very low risk, slow and steady guy, and having the stock market go up and down 30% a year is just the wrong fit for me, right? So I looked at different ways to invest, came across the concept of cash flow, and I started to dip my toe into, as a passive investor in the syndications, into real estate opportunities in 2002. And my thesis was that I was targeting lower risk, kind of highly occupied cash flowing properties. And the cash flow was meant to be more predictable for me than the lack of predictability of the stock market. And so I ended up rotating all my money from stocks and bonds into cash flow between '02 and '07. And I actually ended up with the last straw moment in the corporate world. So in '02, when I started this, I was actually working at Disney headquarters, middle level manager on DVD and VHS for those of you who are really old. And that was across all kinds of brands like Disney, Touchstone, Miramax, ABC, ESPN, all kinds of stuff. And then in 2007, I was working at Toyota headquarters here in Los Angeles, had a last straw moment with my manager. And I didn't intend to leave the corporate world. I didn't have like this plan as a passive investor to kind of build up cash flow and leave the corporate world. I actually wanted to have the paycheck, and I just wanted the more predictable retirement account side, right? I wanted to have both. But with the last straw moment, I decided to take a risk, leave the corporate world because I had enough cash flow built up to live off of. And that's when I left the corporate world in '07, gave myself a couple of years of Runway. And now it's like, it's going to be 15 years in June. So for that, I did that. So I've been a full-time passive cash flow investor since 2007, but about 15 years. Been investing in real estate since for about 20 years now. And that's where we land here today.
Love it. Well, thanks for that brief synopsis. I want to touch base on a couple different pieces. In 2002, just after the dot-com crash, here you are, you're experiencing all this volatility in the stock market, and you were turned on to this idea of cash flow investing. Now, how did that happen? What was going on? How were you not aware of cash flow investing at that point in time? Super sharp guy, went through Wharton. How were you not aware of cash flow investing, or maybe it just wasn't on your radar? I'm just curious about I know I'm taking clear back to 2002, but I'm interested in your mindset around, okay, maybe it's just because you were in the corporate space and just naturally you were investing in the stock market and you really didn't have your eyes on the real estate world, but maybe just talk through that a little bit. And once you were exposed, what were the steps you took to start, dipping your toe in the real estate world?
Yeah, great questions. And frankly, for me, it's a mix of everything you said plus more. So first thing was back then when I started investing, actually. So 2002, I'm trying to figure out how old I was. I think I was 28. So I was pretty young, okay, relatively speaking. Now, before then, to your point, like at Disney, I was investing in my literally like Disney 401k Fidelity plan, like everybody else at work, right? None of us knew about these real estate opportunities. Another factor, which is really important, is that I was a non-accredited investor when I started. And to be honest, it was much easier to be a non-accredited investor back then than it is today if you're starting today. Just because there was a lot less capital chasing these types of alternative investments. They weren't as well known, and therefore people are much more open to taking non-accredited and accredited capital. Okay, that's changed over time, and I think it will change back a little. And we can talk about that. But and then without complicating, there's also crowdfunding. There's other ways for non-accredited to invest. But the point is, it was easier back then to go right into syndications. Number three is that I'm from Canada, so you have to remember that I wasn't in the U.S. until '98. And I was a student until 2000. So it really was only in the first couple of years of me working in the US that I even started to look into these things, right? So it really didn't take as long as it sounds, because in Canada, this was a very rare way to invest. I actually couldn't even tell you the laws surrounding like creating a private placement memorandum and being, syndicating and all that. I don't know the rules because I never looked into it when I was there. And I was just still really young. And to be totally honest with you, the way that I started was back in like 2000, 2001, when a dot-com crash really happened. I went to, I remember, I went to like Borders. For those of you who remember, it was like bookstores, right, when they existed. And I literally went to an investing section. And because I was fed up with the stock market, I started looking at like, there was Investing for Dummies, all these books, okay, which I don't know who would even know what I'm talking about at this point, but, and
I do. I'm not as young as I look. I'm familiar. Go ahead.
yeah. And so you could open up a book about Investing for Dummies, which is this yellow book at a huge series, and they would talk about, cash flow, and they would talk about car washes and laundromats and the stuff that like way back used to be like this cult following, right? Now it's a little bit different, but that's how it was back then. And so I started to look at different ways to invest. And where I got really lucky, to be totally honest, is that lifelong friends of my family had actually been buying real estate syndicating for like a couple decades at that point from Montreal, but they were buying it in the US, which is just unusual on its own. And I started talking to them at one point, and they told me what they were doing. And when I started to understand what they were doing, I'm like, oh, this could be interesting. And so the very unique thing for me and the very lucky thing for me is when I started investing with them, and I did it in a way that I knew I'd be able to learn, I could trust them, and I would learn a lot more than just investing in a random deal. And so that's how I started the core foundation. And then what I had to do, which was very challenging, but I was young with no kids and I wasn't married at the time, is I went to an average of about 2 to 3 investor meetings a week in Los Angeles in person, okay, after work, which takes a lot of work, right? Especially with the traffic in LA and stuff. So it was a big dedication to that for several years. That went on for years and years. And that's how I started to get exposed to different asset classes and learn not just about multifamily, but all different asset classes. Of course, some of the challenges with some of those, that there were sales pitches, and some of them were just like such a waste of time to like sit in traffic and it's a sales pitch. But some of them really worked out well. And I got better at filtering the meetings. I got go back at the good meetings. And I ended up co-founding in 2007 a nonprofit that actually was investor meetings with the solution, like, how do you go somewhere without a sales pitch? That's what we started, right? We'd actually never made money on it. We lost money every year, but we created a very large group now. And so I kind of was a combination of a lot of things, that eventually got me learning, but got me into this. But I was new to the US, so I was at a bit of a disadvantage going in, so to speak.
Yeah, that makes a lot of sense. I'm curious now, and again, here you are in the corporate world, and you had a connection to passively invest in syndication. So I see why you went straight to passive investing in syndications. Did you ever toy around with investing yourself in like small single family or small multifamily? Did you ever mess around with that, or go straight to passive investing?
I went straight to passive investing, and the closest I came to something like that is that because I was reading all the other books about cash flow, like I actually started talking to business brokers about buying literally like a Quiznos or something like that would cash flow, but it was active and involved a lot of work, frankly. It was one of the ways I was potentially going to get out of the corporate world, honestly. So I looked at that angle. So I looked at a lot of different things. The thing is that when you went to the bookstore in 2000, 2001, 2002, there weren't syndication books. I mean, there may have been one or two, but for every one or two that you couldn't find, there were 20 books about cash flow, alternative investments, all these other things. And that's that's basically where I started to begin with. And so that's why I went down that path. It was just really hard back then. There just was no public marketing to investors. It was really hard to learn about this.
Yeah. Okay. So I'm curious, you you overemphasize, not overemphasize, you emphasize the cash flow investor aspect of your persona, right? You're known as the cash flow guy as you go to different conferences and speak, and you're asked to, on a lot of different podcasts. What would you say to the investor that's listening right now that says, no one's really become extremely wealthy on cash flow? It's generally on the equity play. What are your thoughts on that concept as it relates to someone who's looking to build a portfolio? Maybe they don't come from a background of having a lot of money to work with. They're trying to build their wealth and cash flow at the same time, but they're maybe focusing more on the equity play early on to build up a nest egg that they can start investing for cash flow. What are your thoughts on that concept?
Yeah, I mean, look, I think that makes a lot of sense for a lot of people. I think that, frankly, I think what you say is true. If you're just focused on a 100% occupied multifamily building with very little value add, you're only going to get so far, as an example, right? Now, we can get into what I did because I did all kinds of stuff to build wealth, but also try to get the cash flow base. But I will say in general that I was looking for predictability, and I was looking to build wealth really slowly because I had a multi-decade retirement philosophy. And so what I did was I finally got the base where I needed to be, and then I started to expand into medium and higher risk opportunities. And I did sprinkle a little bit of that in during that time where, when I was ramping things up. But in the end of the day, like if you look at my total net worth, a good amount of it now has actually come from more high risk opportunities, both startups and stuff, like not the stuff that we're talking about. But to me, I had to have this core foundation because I'm really low risk. I had to have, in fact, when I left the corp world in 2007, I had a 2-to-1 cash flow coverage ratio in terms of cost of living at the time versus the cash flow. And that was important for me because I was so low risk that, like, if some of it went away, what was going to happen? So I was just focused on this base. Like, it's almost like a business person who's just trying to build their base foundation of understanding or the base of the business for a number of years. And then they have the entire base solid, and now they're about to ramp up, right? So to me, I had to do it in order based on my risk profile. So, but I think that for someone who's brand new, who needs to build equity, you probably don't necessarily want to take a pure cash flow play because, to your point, that's actually not what your short-term goal is. There's 1,000 ways to invest. None of them are wrong, and it's got to fit your needs at the time. So I fully agree with you on someone else taking a different strategy for sure.
Yeah, makes sense. So let's talk a little bit about what you see on the horizon. And I know you get asked the questions like this all the time, but and you don't have the crystal ball. But I'm just interested in getting your general thoughts on where we're at in the market cycle and what you see playing out in the coming couple years.
Yeah. So here's what I see, and I'm one person's opinion. I'm not a financial advisor, and anything like that. It's just my perspective as an investor. But I see that we were in a record long, economic cycle up until the pandemic. Some people believe we had a recession and that we had a reset. I don't. I believe that we were about to go into recession in March of 2020, based on all the economic data, even before the pandemic happened. And I think that would have caused a normal reset. But because of what happened in the pandemic, we had an enormous amount, $9 trillion printed, that basically further delayed a proper reset and a recession. And by the way, technically speaking, I think we had the fastest recession ever. But I don't think it should qualify as a recession, only because it's typically 2 quarters and it wasn't 2 quarters. So it doesn't even though some people are saying it was a recession. So that's something you could definitely debate. And what happened is that we had an unbelievable amount of tailwinds in the last year or two. So we had eviction moratoriums, foreclosure forbearance, stimulus programs, unbelievable money printing. And that caused an enormous amount of dollars put in people's pockets that pulled forward consumer demand by years. Okay, not by months, but by years. And that was shown in the savings rate and everything else that we saw. And now the savings rate is back to normal. People have now spent the money. The vast majority is now, the stimulus is behind us. And now things are slowing, right? So I feel like we're going from a huge amount of tailwinds to a huge amount of headwinds this year. Because now in 2022, and we're recording this in early 2022 right now, we have the exact opposite of what we had before. We have quantitative easing ending. We have interest rates supposedly going to be going up with the Fed. We have the end of all this money printing, it seems. We have the end of all these emergency stimulus measures in the vast majority of cases and pandemic measures. And so we have the exact opposite, and yet we're also fighting with inflation which the Fed seems to have to get control over, there's going to be massive problems. So we've gone from literally as many tailwinds as you could possibly ask for to a lot of headwinds. And so what I'm expecting in the next couple of years is interest rates to increase based on what the Fed has told us. And if that happens, you have to expect values to either level off or come down. That's what historically happens. I'm expecting them to come down. I'm expecting us to finally have a recession as a result of all this. I will tell you that the Fed has raised rates 11 times, in the past century. And the only times that they haven't caused a recession was the two world wars and the Great Recession. So, and that's it. And so very high probability they're going to cause, if they hike rates 3 or more times, it's very probable they're going to cause a recession. If we get a recession, we're probably going to get a further reset in asset prices and an economic downturn. And the one thing that nobody's talking about, which I'm fascinated by, is that with inflation, so, the published inflation is currently 7.5% by the government. But if you take the way it used to be calculated and like take away, in fact, they even changed the way it's calculated in January. Most people don't know this. They even tweaked it even more to make it look a little lower. And so, but they did it in 1982 in a big way to finally get out of the whole inflationary problem they had. Pre-1982 calculations, we're at 15% inflation right now. And so if you assume we're between 10 and 15% inflation, and yet you're in any type of property, and it's not earning a revenue increase of 10 to 15%, your NOI is lower at the end of the year than the beginning of the year. And that means that I'm concerned that we have this compounded potential effect of a reduction in property values. You have an NOI that is actually lower at the end of the year, the beginning of the year, which at the exact same cap rate means your property is worth less, which I've never faced in 20 years before. And the other piece that compounds on top of that is the likelihood that when interest rates go up, cap rates are going to go up and multiples are going to go down. So I'm very concerned about valuations in the next 12 to 24 months. So I'm watching that very carefully and being very, very selective on what I'm doing right now as a result. I'm trying to avoid price decreases, which is my number one concern right now.
Okay, so knowing all that, and I appreciate that summary, what does someone like you invest in moving forward? And then, well, let's start there. Let's talk about what you're investing in, maybe in the last 12, what you've done in the last 12 months, and what you expect to be doing in the next 12 months, based upon that summary of what's happening in the market.
Yeah. So I'm doing similar stuff this year to what I was last year, which is not what I like to do. And it's not the traditional stuff. And it's not traditional multifamily deal for me, for example. I've gotten 3 buckets that I focused on. Okay. So one of them is short-term, the opportunities where I hopefully will have my money back within 12 months. And the purpose of that is that if asset prices do adjust, I want to be able to redeploy that capital into a lower asset price. Okay. So that's number one, really easy example is hard money lending on single family home flips in first position. I do that every year anyway, typically. I did a record amount of it last year when supply and demand imbalance was very in favor of investors because we had just a very short supply and high demand from, home buyers. I feel like I've done a little bit less of it this year. I just redeployed, but I'm still doing a good amount of that. And again, going to reassess at the end of the year across everything, right? So short-term stuff. Number 2 is unique opportunities where I'm compelled, because there's always unique opportunities. They're just really hard to find where I'm compelled to still move forward. So, if I said to you, how many apartment buildings do you think I invested in last year? What would your answer be?
0.
0. I assumed you had said that. Thank God you said that. It's probably about 7 actually.
Okay.
Okay. But they all had one common thing. They were all tax abated deals. There may have been 1 or 2 low income housing tax credit deals. They were all tax abated deals, very unusual. And I can get into it if you want, but the bottom line is that when it was under contract, it wasn't tax abated. Sponsor had a deal with the housing authority that was local, became income restricted building on half the units, removed 75% of the taxes with no effect on revenues. And what happens there? Your appraisal with a much higher NOI before you actually close literally covers 100 or plus % of the equity, meaning as an investor, I had literally 1-to-1 equity coverage ratio based on the new value, based off the entire new structure. Highly unusual. And not only did I have much higher cash flow from a Class A property in that type of scenario than normal, but I had, more importantly, there was downside risk protection in case asset prices adjust, because that's my number one concern. So that was number 2, and that's why I did a lot of those.
So okay, we talked about your number 1 bucket. Number 2 bucket is unique opportunity. I want to pause there and just dive into this sort of tax abatement, unique opportunities, right? So this tax abatement deal, just to use as an example of this, this bucket number 2, was this a deal that you knew going in that it was going to be a deal where you could, burn off those restrictions, and it was going to increase NOI dramatically. Did you know that going in? Did the operator note that, or was it something just unusual about the deal?
No, it's actually not that. So I know that a lot of deals are like that are purchased that are already tax abated. This
Mm,
operator was actually pre-negotiating structures with a local housing authority, then putting something under contract. So it goes under contract as a
mm,
regular building that's way under market rents. It kind of they tie up the whole tax abatement deal during due diligence, and there's a contingency they have to get it to close, or they don't have to close. And then by the time the deal closes, it becomes rent restricted on half the units, but it also becomes tax abated from the start. And so
mm.
what they do is the brilliance of it is they target buildings that are newer and that are way under market rents to the point where when you actually convert half the units to rent restricted, they're so below market rents, there's no adjustment of revenues. There is adjustment of revenues going forward, but there's no current adjustment of revenues. All they do is remove 75% of the taxes, which often takes out 20% of the expenses. And when you remove 20% of expenses with no impact on revenues, the value of the property goes way up. Okay.
Go ahead. Sorry, didn't mean to cut
Yeah.
you
So
off.
that's where you get the equity coverage at closing. And then, of course, the implied cap rate in that to that extent is significantly higher than what you're actually under contract at, and your cash flow is much higher than it would be otherwise when you close.
Okay. So then let's talk about sourcing unique opportunities then.
Yeah.
So, the average passive investor has the deal flow that sort of comes into their inbox. When you're not out, I assume you personally are not out sourcing opportunities. So you have to have a lot of operators that you're working with that are feeding you opportunities, and then either you are identifying unique ones or you have operators that are specifically looking for unique opportunities. That's not a question, but hopefully you get what I'm asking. How do you source those type of opportunities as a passive investor?
Yeah, great question. Well, look, it's what I would say is I've been networking for like 20 years, and to me, networking is the absolute key to doing this full time for myself. That's my number one focus, is what I do all day long. And so, some of what I find that's unique. I mean, actually, those deals I told you about was just from one operator I've invested with since 2013, who actually
Mm,
pivoted and started the strategy in 2018. But I've invested in them like 20 times in other multifamily deals, et cetera. So that's where that came from. So some of it's going to come from legacy people I've already invested with, and some of it's going to come from networking of stuff that I either proactively find because I'm talking to a new sponsor, or other investors may send me opportunities, or other investor groups I'm talking to may have opportunities. So it's all networking. So whether it's unique or not, everything's coming from networking regardless, in what I'm finding.
yeah, makes sense. Okay, I we dove down the rabbit hole on opportunity. Anything else as it relates to bucket number two, which is unique opportunities?
No, just gave you that quick example. But there's any time, no matter how bad or good the economy is, there's always unique opportunities. Sometimes it's harder to find them in others, but they're out there. So if you look for them, you will find them. And even at this timing, stuff can still make sense to me. Even when you thought I was doing zero multifamily, I would have thought I'd done zero multifamily last year too, except for these unique situations, right?
Got it.
Um,
And
uh,
then bucket number three.
Bucket number three is opportunities that the best way for me to describe them is I'm worried about asset prices declining or depreciating, right? Or going down and adjusting. Well, what if I can invest in stuff where I don't care if the asset prices decline? So, because they're already going to. So, really good example. I've been investing in ATM machines since 2008 with one operator. Started investing with the second operator in 2017. That's computer. Those are computer equipment. They're a screen, a bill feeder, a case, and a keypad. It's going to zero. It's going to go to 5% residual in 5 to 7 years. I don't care if that happens quicker or not. What I care about is predictability of the cash flow that's underlying that in the business. And if I think that can get through a recession and do okay, then I actually am going to move forward and invest, because I don't really care whether that ATM is worth less than I thought in a year from now. So that's one really good example. And I have some others too. But that's actually one thing. In fact, I just made another investment in an ATM fund last week, just as like additional tranche. And so that checks the box for me on avoiding depreciating asset value, because in that case, it doesn't matter.
Yeah, makes sense. Okay, cool. So, moving forward, then, and again, here's the caveat: you're not a financial advisor. You're not giving investing advice here. But with that caveat, if you were guiding someone who is earlier in their investing career, like we talked about before, someone who's earlier in their investing career and is maybe optimizing for equity more than they are cash flow, what kind of guidance would you give them as far as moving forward in the next 12, 24 months?
Yeah, great question. So look, I don't invest like that. And so the best I could think of, because I'm definitely the wrong person to answer this question, is at this particular timing, if you're going to look for appreciation in a time where, let's say, I'm concerned that asset prices are going to depreciate, one of the things you could do to mitigate your risk is focus on stuff that has a quick payback. So taking a lot of money off the table as quickly as possible so that if the underlying asset does depreciate, you've actually now protected it to an extent your initial capital. So that's the best coming to mind to me. And I mean, I can give you an example of a situation like I've done that falls under that. That's not real estate.
Let's hear it.
Okay. I mean, look, I don't invest in Bitcoin. There's no cash flow. I have no idea if it's going to be worth more or less next year. I have no clue. But I want to get the diversification into that asset class because it's probably a smart thing to do, because what if it goes up, right? It's just diversification strategy. So rather than buy Bitcoin, I invested in Bitcoin mining, which the interesting thing about it is that this particular fund that I invested in is very large. It's another Wharton grad that I know. Probably going to have $100 million additional to pull it into it this year. And because they're so large, they have economies of scale. Their cost to mint a Bitcoin is $10,000. So that's the break even. So this way, if Bitcoin goes from 40,000 to 20,000, it depreciates. I'm still making money. Okay. Mm-hmm. Furthermore, I get 80 to 90% bonus depreciation in year one to recoup some of my capital pretty quickly. And the projected payback period based on the cost of minting the Bitcoin or mining the Bitcoin is between 12 and 18 months. So between the depreciation and the quick recoup time, theoretically, I'm projected on my money back in a year. And what may be a depreciation, not only is depreciating any assets, but it may be the actual Bitcoin itself may go down. Right. So, but the point is that, and it is actually a growth play, right? It's a cash flow play, but it's not meant to have the typical return that I look for. It's hopefully going to be higher. So in that case, I'm taking my money off the table very quickly, protecting the capital, still getting some potential upside in the future, but having some downside limited protection in case the asset prices do depreciate. So it's not perfectly what we were talking about, but it's an example, at least it hopefully makes sense to some people.
Yeah, absolutely. Well, look, Jeremy, I've enjoyed our conversation. I appreciate you giving us some insight into your background, sort of your backstory, and how you got into the passive investing side and ultimately exiting the corporate world, and some of your thoughts as far as investing in this market and what we're going to see moving forward. I want to start winding down here, but a few final questions for you. The first is, what's the biggest challenge that you're facing right now in your business that we could all learn from?
Well, the biggest challenge I'm facing right now, given that I look for cash flow, but I'm very concerned about asset price depreciation, is that I'm having trouble deploying my capital and there's rampant inflation. And every month that goes by, my money's worth less. And, Ray Dalio, very well-known person, I think he manages the largest fund in the world, Bridgewater, his famous quote is cash is trash. And it's true. And that is my biggest challenge. Cash is trash. And yet it's hard for me to deploy my capital right now. So that's my biggest challenge today when we're recording this.
Yeah. What's something that you're just absolutely knocking out of the park in your business, just doing very, very well in your business today, right now, that we could all learn from?
Well, that's a great question. It's funny, not much is coming to mind because I'm very frustrated about the market conditions. Look, I mean, I would say this, I've been investing in ATMs since 2008. I've probably averaged about 30% annualized and reinvested in it and compounded over all that time. So, and that's still working extremely well today. In fact, I mentioned I just redeployed last week into another tranche. So that's been working extremely well and is doing very well for me. And frankly, the funny thing is when I got out of the corporate world, within a few years, just the cash flow from that source was paying for my rent. And I actually I own all these different, properties through the syndications, but I still rent a home. And it finally just got to the point where the ATMs are now paying for the home I'm renting because I'm in LA. So that's going pretty well and has gone very well for a very long time.
And I missed when I caught the 30% average compound return, but what about when did you start investing? You said
2008.
2008. Okay. So,
yeah.
You got one track record.
Yeah, and if you keep reinvesting and run the numbers since then on a spreadsheet, the compounding is very powerful.
And how much runway do you think ATMs have moving forward from a technological perspective?
That's a great question. I don't know the answer, of course.
Yeah.
So the way I've looked at that is that when I go to invest with the larger operator right now, the projected payback period, if you include the bonus depreciation, if you can use it, the 100% bonus depreciation is 3 years. So going back to like taking your money and risk off the table, if I feel like there's 3 years of runway as far as without a major technology shift that will disrupt the cash flow, I'll keep moving forward. My biggest concern, in fact, is the central bank digital currency. It's not even so much the Venmos of the world, because I've been hearing about the Venmos of the world since 2008, literally. Okay, and I can tell you stories about that. But it's really about the central bank digital currency and if and when that's going to be deployed and how that's going to impact the use of cash going forward. I'm monitoring that very carefully. So,
Love it. Well, Jeremy, this has been a great conversation. I've enjoyed, hearing about your story and getting some insights from you. What's the best way for our listeners to connect with you and learn more about what you have going on?
Absolutely. Thank you for offering that. So, look, I'm happy to discuss anything with anybody. If you're just brand new and you just want some help, I'm happy to help. If you're an experienced investor or another investor group or sponsor, you want to network, I'm happy to do that too. So the best way to reach me is my email, which is jroll, JROLL, at Roll Investments, ROLL, investments with an S.com. So jroll at rollinvestments.com.
Awesome. We'll have a link to Jeremy's email in the show notes. So if you're listening and you enjoyed the conversation that we had with Jeremy, go down in the show notes right now, click on that link and connect with him. Jeremy, again, an honor to have you on the show. Thank you for spending some time with us, and I look forward to connecting with you again soon.
Absolutely. I just hope that this episode was helpful for your listeners.
Absolutely was. Thanks, Jeremy.